and panelists for a very engaging and insightful discussion, especially in such uncertain times and in the absence of a crystal ball. I hope we've all at least gained a little more clarity about what we are likely to expect following this pandemic. I'm now delighted to introduce our final session for today, our keynote speaker, Mr. Tom Orlick, who has very kindly agreed to join us all the way from Washington, DC, where I work out it's about 6 o'clock in the morning his time. So Tom is chief economist at Bloomberg. Prior to working in China for a decade as chief Asia economics and correspondent for the Wall Street Journal, he also worked at the British Treasury, the European Commission, and the International Monetary Fund. Tom is also the author of 2 books. The first one, Understanding China's Economic Indicators, and most recently, China, the Bubble That Never Pops. I'm very pleased now to welcome Tom onto the screen.
Well, thanks very much, Vicky, and thanks very much to AFME for putting together this important event and inviting me to speak. As Vicky mentioned, it's just getting past 6 o'clock in the morning here in Washington, DC, and yesterday, unfortunately, we had 160,000 new COVID cases nationwide. So I guess in my presentation, I'm providing a literal and a figurative test of the famous expression, the hour is darkest before the dawn. So I'm going to speak about 2 things. I'm going to talk about the outlook for the global economy as we approach 2021. And then I'm going to talk about my personal area of expertise, the Chinese economy. And I'm going to talk about how the COVID crisis should reshape our view of how China works and China's economic prospects. So first of all, let's talk about the outlook for the world economy in 2021. So it's become common over the course of the COVID shock to speak about the shape of the recovery in terms of letters of the alphabet. Everyone hopes for a V, where the level of output drops, but then bounces back quickly and gets onto its pre-crisis trend. Everyone fears an L, where the level of output drops and then growth comes back, but the level of output never gets back onto that pre-crisis trend. What are we going to get in the COVID shock? Well, it seems that we're not going to get a V or an L. It looks very much like we're going to get a W. At least that's the story which is being told by our daily activity indicators. One of the characteristics of the COVID shock is that it's hit too quickly for conventional data, the monthly and quarterly numbers we're all used to looking at to tell us a story about the economy, to keep track. At Bloomberg Economics, we've used that as an opportunity to pivot to using more high-frequency alternative data. We're looking at numbers like electricity consumption, public transport usage, and mobility, which are available on a daily basis. And we're putting them through a statistical filter which increases the signal and reduces the noise. And by doing that, we've managed to create daily activity indicators across the world's major advanced and emerging markets. You can see our advanced economy activity indicators here. And what they're telling us is that in many European countries, the second downturn has already begun. Now, the bad news is that there will be a second downturn. The good news is that we expect the second downturn to be less severe than the first. Schools are likely to stay open. Factories are likely to stay open. And that means that the dip as we head into the fourth quarter will be severe, extremely severe measured against normal times, but relative to the cratering of output that we saw in the second quarter of the year, the downturn in the fourth quarter will be much more moderate. By the time we get into the first quarter of 2021, at least in Europe, we expect containment measures to have been successful in containing the virus. We expect more fiscal stimulus to have sustained incomes during the downturn and prepared the economy for recovery. And we expect vaccine trials from Pfizer, Moderna, and others to be proving successful, and the distribution of a vaccine to be either already underway or imminent. What that means is that we expect for the global economy that the fourth quarter stall will be followed by the beginning of a second recovery at the start of 2021. And by the middle of 2021, with the vaccine under control, fiscal stimulus in place, and the vaccine on the way, we expect growth to be firmly on a recovery path. Now, the picture is going to look a bit different across different regions. In Asia, China, Japan, and Korea have already largely controlled the spread of the virus. And what that means is that they will be spared the double dip downturn. In Europe, many countries are imposing lockdown controls, which will mean a downturn in the fourth quarter and a recovery in the first. In the United States, the attitude of the government to managing the virus is really very different. And of course, you'll all know that the US is really at an extraordinary moment with a messy transition between the Trump administration and the incoming administration of President-elect Joe Biden. What that will probably mean is that there's no coordinated lockdown policy in the US in the fourth quarter, and so no big recovery in the first quarter. So whilst in Europe we expect to see a pattern of downturn and then recovery in Q4 and Q1, in the US we expect something which looks more like a stall spread across both quarters. If you pull all of those pieces together, for the global economy, we're expecting a contraction of around 4% in 2020 and a rebound to just over 5% growth in 2021. What does this all mean for policy? Well, in a normal recession, central banks would be the first responders to the economic downturn, cutting interest rates to put a floor under growth and attempt to accelerate the recovery. In the COVID crisis, of course, many central banks entered the crisis with central banks already too low to provide effective support. Central banks did a good job in the first half of 2020, stabilizing financial markets. With markets stable, they've been pushed into an extraordinary new role as we see a reconfiguration of fiscal and monetary policy. Central banks are essentially printing money to buy assets to finance government stimulus spending. And you can see the very tight relationship between central bank asset purchases and the increase in government debt over the course of 2020 in this chart. Now, with output gaps wide as far as the forecast can see, there's no real risk that inflation is going to pick up. And so this extraordinary new policy stance for central banks is sustainable, at least in the short to medium term. Even so, we expect to see some significant differences across countries. In the Eurozone, we think the ECB is still in whatever it takes mode. We expect the announcement of a fresh round of asset purchases at the December meeting, and we think that will provide Eurozone member states with the financing they need to extend their fiscal stimulus. In the UK, the Bank of England is ahead of the ECB in terms of announcing additional stimulus, but perhaps will end up being behind the ECB in terms of the amount of stimulus it's providing. By our calculations, the latest round of QE by the Bank of England will only be enough to cover around half of the required increase in financing from the Treasury in 2021. What that means is that in the UK, the market will be providing a larger share of financing for the government, introducing the possibility that yields could start to move higher. In the United States, we see a different story again. In the United States, with a Democrat in the White House, and with the probability of a divided Congress, we still await the outcome of the Senate runoff in Georgia. But at the moment, the most likely outcome would appear to be that Republicans retain control of the Senate. The very real possibility is fiscal gridlock, with President-elect Joe Biden calling for more spending, and Republicans in the Senate pivoting to focus on concerns about the debt. In that context, we could see fiscal stimulus disappointing expectations, and that resulting in a further drag on growth at the start of 2021. So let me pivot here to talk about the outlook for China's economy. Um, so I spent 11 years in China from 2007 to 2018. And throughout that time, my observation is that Western economists had an overwhelmingly negative view of China. Um, the COVID crisis, I think, provides an opportunity to look at China through fresh eyes and possibly recalibrate our view of how the economy works. So, first of all, let's think about the typical way in which Western economists tend to view China. Um, I think it's fair to say that there are three big problems that we tend to identify. First, China has had a big increase in debt. This chart tells the story. In 2008, China's debt was low and stable at around 150% of GDP. By 2015, it's accelerated all the way up to 250% of GDP. And when we see such a big increase in debt, we worry that it could be the trigger for a financial crisis. Secondly, we worry about the massive state sector of the Chinese economy. Banks, industrial firms, telecom firms, transport firms, all owned by the government. And we worry that this is a massive source of inefficiency, a wellspring of corruption, a drag on growth. And lastly, we worry that China's leaders are ineffective, either committee men who can't take difficult decisions or strong men who can take difficult decisions but often take the wrong ones. So if this view of China's economy was correct, if China was an economy defined by debt, inefficiency, and weak leadership, then when the COVID crisis hit, we should have seen a failure to contain the virus, a deep recession, and a financial crisis. And of course, that's not what we've seen. As this chart shows, China experienced a deep downturn in the first quarter of 2020, but it has also had a rapid recovery. The virus was quickly contained, the economy restarted. China is the only major economy in the world that can claim to have a V-shaped recovery. The banks are still standing, and financial markets throughout the period have been remarkably stable. So I think the fact that China has outperformed expectations in terms of the performance of its economy and financial system through the COVID crisis should give us pause for thought on those preconceptions we have about the supposed deep problems in the Chinese economy. So let's examine them again. Firstly, very high debt. Well, yes, China does have a problem with high debt, and that debt has increased very rapidly. But financial crises do not start on the asset side of bank balance sheets. Financial crises typically start on the liability side of bank balance sheets. They start because banks run out of funds. And in China, because the banking system is extremely well funded, underpinned by a very high national savings rate, the trigger for crisis is really just not there. And in a period where borrowers run into trouble, as they did in the first quarter during the COVID shock, banks have the capacity to extend forbearance, saying, don't pay us back, don't worry about paying us back this quarter. We know there's a crisis. You can pay us back next quarter or even next year. The state sector of the economy is big and it is a source of inefficiency. And there is a serious problem with corruption. But the state sector of the economy is also a lever which the government can pull to achieve its development objectives and to balance the ups and downs of the economic cycle. China probably won't be the first company. China probably won't be the first nation to bring a coronavirus vaccine to market. But there are some Chinese companies which are in the race, and they are state-owned enterprises. State-owned enterprises are not just a source of inefficiency, they are also a driver of innovative potential. And state-owned enterprises can also balance the ups and downs of China's economic cycle. As the COVID crisis hit, private sector firms in China and in many other countries stopped hiring, let go of some workers, cancelled their investment projects. But the state sector, acting under instructions from Beijing, held on to their workers and once lockdown was over, accelerated capital spending. That's why China has been first and fastest out of the COVID shock. That's why they are the only major economy in the world which has hopes of something that looks like a V-shaped recovery. And as for ineffective leadership, well, I certainly don't think that China's leaders get everything right. And in terms of their social policy, they do a huge amount, which I disagree with. But on management of the virus and on management of the economy, in common with democratic neighbors in Korea and Japan, I think we have to acknowledge that Beijing has done a pretty good job. Put those pieces together, and we think that China's economy will grow around 2% this year and around 8% in 2021. So let's think a bit about China's longer term. So at Bloomberg Economics, my team have put together those daily activity indicators, providing the nowcast on what's happening to the economy right now. We have medium-term forecasts looking at the quarterly growth profile on a 4-year time horizon. We've also got long-term growth forecasts looking at potential growth across major economies all the way out to 2050. You can see those numbers for China in this chart. And what they're telling you is that China faces a continued slowdown. There is a demographic drag as the workforce ages and shrinks. And there is also development fatigue. It's relatively easy to grow quickly when you're at the early stages of development, harder to grow quickly as your economy advances towards the technology frontier. So we expect China to slow, but even as China slows, it will continue to outpace the rest of the world. And what that means for AFME members and other big investors is that in the years and decades ahead, China will present an intriguing opportunity. On the one hand, China will continue to play a bigger and bigger role in the global economy, and China's capital markets are slowly creaking open, with more and more paths for global investors to move money into the bond and equity markets. On the other hand, because of the very real challenge of deleveraging, managing down that enormous stock of debt which China took on in the period from 2008 to around 2015, China's financial markets will be an unusually eventful place, especially as the government attempts to manage a transition from a implicit no default guarantee to a world where market pricing is allowed to play a bigger role and defaults do take place and the problem of moral hazard is stripped away. Let me conclude there. Thank you very much for your attention. If you're interested in more of our research at Bloomberg, you can see all of the work by me and my team at Beco Go on the Bloomberg terminal. If you're interested in more on my views on China, you can see them on the Bloomberg terminal. As Vicky mentioned, you can also read my book, China, the Bubble That Never Pops, that was published by Oxford University Press over the summer. Let me end there, and I'm happy to take a few questions if we have questions, Vicky.
Tom, yes, thank you very much for such a thought-provoking presentation. We are actually very tight on time, so we can only take one question. I can see people have submitted a few on Slido, so I'll just take the one that's got the most votes. So the question is there a risk that future governments will be incentivized to let inflation creep up to help manage their huge new debts? What are your views on that, Tom?
So, inflation is the kind of nightmare scenario for the next couple of years, right? The only reason why this extraordinary new configuration of central bank financing for deficit spending is possible is because there is no inflation. As soon as inflation comes back, central banks face an impossible trade-off between financing the recovery and managing inflation pressure. And really that's impossible to do. And so as soon as we see price pressure coming back, this whole new macro framework really doesn't work anymore. So why didn't I spend a bit more time talking about inflation in my presentation? Well, it's really because we just see enormous output gaps as far as the forecast stretches. And whilst there are a few countries, India, Mexico, where there are some local circumstances which are pushing inflation higher, globally, and certainly in Europe and the United States, we don't see inflation as a problem over the forecast horizon. Looking further out, once the recovery is in track, yes, absolutely. Once the recovery is in place and the need for central bank support is removed, yes, absolutely, running nominal growth higher, pushing tax revenue higher, pushing corporate profits higher, these are going to be ways in which the governments attempt to manage down the debt burden. Whether they're successful in doing so in the face of the whole secular stagnation narrative, which means global pressure for lower prices, well, that remains to be seen.
Lovely. Tom, thank you very much. Apologies to other people that had submitted questions. We're unfortunately out of time now. But thank you very much, Tom. It's been a pleasure hearing from you today. And on behalf of AFME and our audience, we really appreciate you taking time out of your busy schedule and, of course, joining us at 6 o'clock in the morning your time. So thank you.
Great to be here. Thanks, Vicky.
Okay, as we start to draw the main discussions to an end, I would now like to introduce Natasha Hilger. She is Relationship Manager, European Debt Management Offices at Deutsche Bank. She is also co-chair of AFME's Primary Dealer Board. Natasha will provide us with some thoughtful conclusions and key takeaways from this morning. Thank you, Natasha.
Hello, everyone. Yes, so we first saw that virtual conference is working pretty well, and that we have all faced unprecedented time this year, especially the governments, to face with the crisis. So we have heard a large consensus is in believing that central bank intervention will continue, will be here to stay for longer. So not only with the extraordinary QE measures, but also cheap loan to banks, easy monetary policy stance, and so on. So the roles the central bank has played has been crucial, and it has been very re-engaging instruments for investors to invest in the European bond market, because the whole market could rely on the buying purchase with the objective not to impact the liquidity, but to stabilize the market. So the ECB has been adapting to the supply. We have seen that electronification continue its path, but there is no distortion on voice trades despite working for home structure. On the central bank intervention, obviously it will continue to be supportive for 2021. We have heard even that it will be even more supportive for SUPRA. The EU is a game changer for European bond market, and we expect this issuer to behave more from a SUPRA to a government-like issuer in the next time with the recovery fund. The focus will remain on ESG issuance and investment from investors. So the importance of the EU taxonomy for the global standard is there. The main leading geopolitical concern for next year seems to be the COVID-19 and its aftermath still, and we just heard that the recovery shape will have a V form, a W form instead of a V form. Thank you.
Natasha, thank you very much for so nicely compressing the many takeaways from this morning's conversations. On that note, I would like to thank all our excellent speakers who have so generously given their time, knowledge, and expertise to make today possible. I also want to extend my personal thanks to our conference partners. We have Citi, TradeWeb, MTS Markets, and Transfic. Thank you for your ongoing support. It's helped make today possible and bring us together in this virtual environment. At this point, I'd like to remind everyone that we would greatly value any feedback that you have on this year's conference, and also any suggestions for next year's programme, so we can get started on that. This can actually be done through Slido and should actually be on your screens right now. I've been told it only takes a minute to complete, so we would really value any feedback that you have there. Now, that might be the end of our panel discussions and our talks, but up next, in addition to our sponsorship partner booths, we've got a great networking session lined up, which we hope will be a nice interactive way to end the conference. So this session will allow you to chat face-to-face with others by choosing to join tables in the virtual venues. You'll be able to see the names of people who are also on the platform and available to network, and you'll be able to move around the floor to visit some different tables. So how do we get there? I hear you ask. If you could please join us by going to the More tab on the left-hand sidebar. So on your screen, on the left-hand side, you'll see More. I think it's about 3 dots. And if you click on there, it will say Networking Tables. Click on Networking Tables, and you will then be redirected to the Roundtable Networking website. You'll then be prompted to quickly enter your email, name, and create a password. Now, if you're anything like me, I don't like setting up passwords, but this is a one-off thing, so it doesn't really matter what you put in. To enjoy this type of networking, you'll also need to allow your camera and microphone at the final stage setup. So you'll need to enable those just so you can actually see and talk to the people you want to network with. A couple of other quick tips as well. To change seats, you'll just need to click on the other tables. If you want a fuller view of all the tables on the floor, just click somewhere in the middle of the floor pan and drag and drop in different directions. If you require any support at all, you can contact our colleagues, Anna or Jill, and their details are listed just under the networking tables on the More tab. And last but not least, I would really like to thank you, our audience, for joining our conference today. It hasn't been an easy year for anyone, so your support at a virtual event is really immensely appreciated. We look forward to seeing you all this time next year, hopefully in person in Brussels. Thank you very much indeed. I look forward to networking with you all.